A stock market crash can be a challenging and stressful time for investors. However, there are several ways to survive and even thrive during a stock market crash. Here are several strategies that you can use to prepare for and navigate a market downturn. Keep watching till the end. The last strategy is worth your time. Avoid panic selling. During a market crash, it can be tempting to sell all of your investments to avoid further losses. However, this is usually not the best strategy. Selling your investments at a low point in the market can lock in your losses and make it difficult to recover your losses when the market eventually rebounds. Instead, it may be better to hold on to your investments and wait for the market to recover. Consider buying opportunities. Maybe it's the other way around. Instead of selling, we should be buying. A market crash can also present buying opportunities for investors. When stock prices are low, it may be a good time to buy high-quality stocks at a discount. Look for companies with strong fundamentals and a solid track record, and consider investing for the long term. Rebalance your portfolio. During a market crash, your portfolio may become unbalanced, as some assets lose value more quickly than others. To keep your portfolio on track, consider rebalancing your investments. This means selling some of the assets that have performed well and investing in assets that have underperformed. See? Reverse strategy. Have a long-term perspective. Crashes are part of it. If we take a look at this chart of the stock market crash timeline, the stock market goes through cycles of ups and downs. While a market crash can be painful in the short term, markets have historically recovered over time. Consider defensive stocks. Defensive stocks are those that tend to hold up well during a market downturn because they are less sensitive to economic cycles. These can include companies in industries such as healthcare, utilities, and consumer staples. Here are a few examples of defensive stocks. Consumer staples, companies that produce essential goods and services such as food, beverages, household products, and personal care items, tend to perform well during economic downturns because people still need to purchase these items regardless of the state of the economy. Examples of consumer staple companies include Procter & Gamble, Coca-Cola, and Walmart. Healthcare. Healthcare stocks can also be considered defensive because people need medical care regardless of the state of the economy. Pharmaceutical companies, hospitals, and health insurance providers are examples of healthcare stocks that may perform well during market downturns. Some examples include Pfizer, Johnson & Johnson, and United Health Group. Utilities. We all need electricity, water, and gas. These companies typically have stable revenue streams and may be less affected by economic cycles. Duke Energy, NextEra Energy, and American Electric Power are examples of said companies. The stock market is always going to fluctuate and crash. That's inevitable. The key is to handle the situation delicately. Stand your ground, minimize your risk, maximize your profits, and make sure that you end up a long-term winner. Live rich and prosper. See you on the next video.